Today, we are going to talk about the recession that most people are completely unprepared for. We're going to talk about what the data is actually telling us right now, what the smartest investors and economists in the world are quietly doing, and, most importantly, exactly what you need to do in the next 30, 60, and 90 days to not just survive this, but potentially come out the other side wealthier than when you started. Stay with me until the end of this video, because the last section is where most people completely miss the opportunity of a lifetime. The data nobody wants to talk about. Let's start with what's actually happening right now in the economy, because the mainstream media is doing a phenomenal job of either catastrophizing or completely downplaying the signals that really matter. And when you don't know which signals to look at, you make emotional decisions. And emotional decisions in a recession are how middle-class wealth gets absolutely obliterated. First, let's talk about the yield curve. The yield curve has been inverted for longer than almost any period in modern financial history. And for those of you who don't know what that means, historically, an inverted yield curve has preceded every single major recession in the last 50 years. Every single one. It's not a perfect predictor, nothing is, but it is the closest thing to a flashing red light that the bond market gives us. And it has been flashing for a while now. Second, consumer credit card debt in the United States has surpassed $1.1 trillion. That is a record high. And what's more concerning is not just the amount, but the delinquency rates. Credit card delinquencies are rising at a pace we haven't seen since the post-2008 recovery period. What that tells you is simple. People are spending money they don't have, and they're starting to fall behind. That is not a healthy consumer. A consumer under that level of financial stress pulls back on spending. And when spending pulls back, GDP contracts. That's the definition of a recession. Third, commercial real estate. This is the sector that most people aren't watching because it's not flashy, it doesn't trend on social media. But commercial real estate is sitting on hundreds of billions of dollars of loans that are coming due in the next 12 to 18 months. Offices are still half empty. Valuations have collapsed in many markets. And the regional banks that hold a massive chunk of these loans, they are extremely exposed. We already saw what happened with Silicon Valley Bank. That was not a one-off event. That was a warning shot. Fourth, unemployment. Now here's where it gets nuanced. The headline unemployment numbers look fine, right? But dig deeper and you see a very different picture. Full-time employment is actually contracting. What's growing are part-time jobs, gig economy jobs, multiple job holders. People are not getting richer from this labor market. They are working harder just to keep up. That is not the foundation of economic strength. That is a foundation that cracks under pressure. All four of these indicators taken together paint a picture that serious economists and institutional investors are already positioning around. The question is, are you? Why this recession will be different? Here's something I want you to really internalize. Not every recession is the same. And one of the biggest mistakes people make is assuming that whatever happened last time is what will happen this time. They panic sell stocks because stocks crashed in 2008. They hoard cash because in 2020 everything felt uncertain. But this potential recession has some unique characteristics that you absolutely need to understand. Number one, inflation changes the playbook. In a typical recession, you have deflation. Prices drop. Cash becomes more powerful. But we have just come out of the highest inflationary period in 40 years. Core inflation, even after all the rate hikes, is still sticky. That means if a recession hits now, we could see something economists call stagflation, low growth and high prices at the same time. This is arguably the worst economic environment to be in because the traditional safe havens don't all work the same way. Cash gets eroded by inflation. Bonds were already destroyed by rate hikes, and equities are facing earnings pressure. This is why preparation in this specific environment requires a nuanced approach. Number 2, interest rates are at multi-decade highs. Think about what that means. Every business, every homeowner, every government that needs to refinance debt is doing so at dramatically higher rates than 5 years ago. That is an enormous drain on cash flows across the entire economy. Small businesses that survived COVID on cheap credit are now suffocating under interest payments. Homeowners who took adjustable rate mortgages are feeling the squeeze. This doesn't resolve quickly. Number 3, geopolitical instability is at its highest in decades. Supply chains that were supposed to recover from COVID are being disrupted again by conflicts, trade tensions, and energy shocks. These are not temporary blips. These are structural changes to the global economic order, and structural changes create long-term headwinds that no amount of central bank intervention can simply paper over. This recession, if and when it arrives in full force, has the potential to be more prolonged and more complex than what we experienced in 2020. In 2020, governments could throw trillions of stimulus at the problem. Interest rates were already near zero, so there was room to cut. Now, that ammunition is largely spent. The policy toolkit is more limited, and that means the recovery could be slower. This is not me trying to scare you. This is me trying to make sure you are not caught off guard. The psychological trap most people fall into. Before we get to the action plan, and we are going to get very specific and tactical, I promise, I need to talk about something that kills more financial outcomes than any market crash ever will. And that is psychological bias. The single biggest enemy of your financial well-being during a recession is not the recession itself. It is your own brain. Human beings are wired to be terrible at financial decisions under stress. We are wired for short-term thinking. We are wired to follow the crowd. And the crowd, my friend, is almost always wrong at the exact moment it matters most. Think about March 2020. The market dropped 35% in a matter of weeks. Panic was everywhere. People were selling everything. The news was apocalyptic. And do you know what happened to those who stayed invested? Or better yet, kept buying? The market recovered to all-time highs within months. The people who panic sold locked in permanent losses. The people who stayed calm followed a plan and kept their eyes on the horizon. They were rewarded massively. The same dynamic will play out in the next recession. There will be a moment, maybe there will be several moments, where it feels like the world is ending financially. Every instinct will tell you to pull out, go to cash, do something to stop the bleeding. And that instinct will be wrong. This is why you need a plan before the panic hits. Not during, not after. Right now, while your brain is calm and rational, you need to decide exactly what you are going to do. Because when the fear is real and the losses are in front of you, your ability to think clearly drops dramatically. The plan you make today protects you from the emotional version of yourself that will show up when things get scary. The 30-day recession. Prep plan. All right, let's get tactical. Here is exactly what I would be doing right now if I were starting from scratch. In the next 30 days, build your financial foundation. Step 1. Know your exact numbers. I cannot stress this enough. Most people have no idea what they actually spend in a month. They have a vague sense of it, but they've never sat down and mapped it out precisely. Your mission in the next 30 days is to audit every single dollar leaving your accounts. Every subscription, every recurring charge, every discretionary expense. Get a precise number for what your life costs. This is your baseline. You cannot build a defense you don't understand. Step 2. Build or reinforce your emergency fund. The rule of thumb used to be 3 months of expenses. In a recessionary environment with job market uncertainty, I would argue you want 6 months minimum. If you're self-employed, a freelancer, or work in an industry that is cyclically sensitive, think real estate, finance, tech, retail. You want to push that toward 9 to 12 months. Yes, that sounds like a lot, but the peace of mind alone, the ability to make rational decisions because you are not in survival mode, is worth every penny sitting in that high-yield savings account. Step 3. Eliminate high-interest debt aggressively. Credit card debt at 20 to 25% interest is a guaranteed negative return on your money. In an economic downturn, carrying that debt is like fighting with a hand tied behind your back. Throw everything you can at it, right now, not later. The 60-day investment repositioning. Now let's talk about your investments, because this is where the real opportunity lives, and also where the most damage can be done if you're not paying attention. In the next 60 days, reposition intelligently, not reactively. I am not telling you to sell everything. I am not telling you to go to cash and wait. That is market timing, and even the professionals get market timing wrong consistently. What I am telling you is to take a hard look at your portfolio and ask yourself one honest question. Is this portfolio structured for an environment of slow growth, elevated inflation, and potential credit stress? Or is it structured for the bull market conditions of 2020 and 2021? If your answer is the latter, then you have work to do. What tends to do relatively well in recessionary environments? Let's talk about it practically. Defensive sectors, things like consumer staples, healthcare, utilities. People still buy food, medicine, and pay their electricity bills even in a recession. These sectors tend to hold up better than growth stocks when the economic environment deteriorates. Dividend-paying stocks with strong balance sheets and consistent cash flows. When growth stops being the dominant investment narrative, cash flow becomes king. Companies that generate real, consistent earnings and return them to shareholders through dividends become significantly more attractive relative to speculative growth companies that are burning cash and relying on future optimism. Short-duration bonds and treasury bills. With interest rates at a multi-decade highs, you can actually get a respectable risk-free return on short-term government securities. This is something investors couldn't say for over a decade. Parking a portion of your portfolio in T-bills isn't just safe. Right now, it actually pays you to be defensive. And here is the contrarian idea that most people are not emotionally ready to execute. Keep some dry powder, cash or near cash equivalents, specifically earmarked for buying opportunities during the recession. Because here's the truth about recessions. They are the greatest wealth transfer events in human history. Money doesn't disappear. It moves. It moves from the unprepared to the prepared, from the reactive to the strategic, from the emotional to the disciplined. The people who became massively wealthy from the 2008 financial crisis were not the ones who saw it coming and went short everything. They were the ones who had cash available and the courage to buy high-quality assets at historically distressed prices. Real estate, stocks, private businesses, all of it was available at a fraction of its true long-term value. And the people who had prepared, who had their emergency fund, who had paid down debt, who had dry powder ready, those people bought, and they never looked back. The 90-day income security review. Let's talk about something that doesn't get enough attention in the personal finance space when discussing recessions, and that is income security and diversification. In the next 90 days, secure and diversify your income. Your job is probably your largest financial asset, and it is also potentially your largest financial risk. If 100% of your income comes from one employer in one industry, you are one layoff notice away from your entire financial plan falling apart. That is a dangerous position to be in when the economic environment is deteriorating. Now, I'm not saying quit your job and start 5 businesses tomorrow. I'm saying, honestly evaluate the resilience of your income. Ask yourself, how recession-proof is my industry? How recession-proof is my specific role and skill set? If your company had to cut 15% of its workforce tomorrow, would you be in that 15% or not? If the answer makes you uncomfortable, start working on your insurance policy right now. That insurance policy looks different for different people. For some, it's building a skill that translates to freelance income. For others, it's starting a small side business that can generate even a few $100s a month. Because a few $100s a month in a downturn can mean the difference between dipping into your emergency fund and keeping it intact. For others, it means expanding your professional network so aggressively that if you were laid off tomorrow, you'd have 3 conversations started within 48 hours. There's also the concept of income diversification, dividend income from investments, rental income if you switch to own property, digital products, consulting, content creation, peer-to-peer lending. None of these need to replace your primary income, but adding even 1 or 2 additional income streams reduces your dependency on any single source. And reduced dependency means reduced vulnerability when the economy gets rough. The opportunity that almost nobody sees. I told you at the beginning of this video that the last section is where most people miss the opportunity of a lifetime. And here it is. Recessions are not just financial crises, they are financial resets. And every reset creates winners and losers. The losers are the people who were over-leveraged, underprepared, and emotionally reactive. The winners, and there are always winners, are the people who treated the downturn not as a catastrophe, but as a repricing event. During a recession, assets that were previously overvalued and out of reach become accessible. Businesses that were overpriced become acquirable. Real estate in desirable markets that was completely unaffordable starts coming back to realistic valuations. Talented employees who were previously locked up in stable jobs become available for hire. Ideas that couldn't get funded in a frothy bull market suddenly find serious investors who are being more selective and more long-term in their thinking. If you are a business owner, a recession is often the best time to make strategic hires, acquire competitors who couldn't survive the downturn, and gain market share from the companies that were running inefficiently during the boom years. If you are an employee, a recession that ends with you still employed, still learning, still building your skills, can accelerate your career trajectory dramatically because the competition thins out. And if you are an investor, which every single one of you watching this should be, the stocks, the real estate investment trusts, the index funds that you dream of owning but always thought were too expensive, in 12, 18, 24 months, they may be on sale. Not because the companies are bad, but because fear drives prices below intrinsic value. And buying quality below intrinsic value is, by definition, how generational wealth is built. This is why I spend so much time talking about preparation, not just defense, but offensive preparation. Yes, protect yourself. Yes, build the emergency fund. Yes, eliminate the debt. But also, position yourself to be a buyer when everyone else is a seller, because that is the most powerful financial position you can possibly be in during a recession. The mindset shift that changes everything. I want to leave you with something that goes beyond spreadsheets and portfolio allocations, because ultimately how you navigate the next 12 to 24 months will be determined less by which specific stocks you own and more by the mental framework you bring to the situation. The people who fail financially during recessions share one thing in common. They are passive. They wait for things to happen to them. They wait for their employer to decide their fate. They wait for the market to recover on its own timeline. They wait for the government or the economy or some external force to rescue them. And sometimes that rescue comes, but often, by the time it does, the damage is already done. The people who thrive share the opposite trait. They are proactive. They don't wait to see how bad it gets. They prepare before it gets bad. They don't wait for the bottom to start buying. They start accumulating quality assets on the way down with money they specifically set aside. They don't wait for their career to be threatened. They start building their next income stream before they ever need it. The mindset shift is moving from, I hope the recession doesn't affect me, to, I am going to prepare so thoroughly that when the recession hits, I am genuinely one of the people who comes out the other side better than I went in. That shift in thinking, from passive to proactive, from reactive to strategic, is the single most valuable thing I can offer you in this entire video. The recession may be coming. The data suggests it is. The timing is uncertain, as it always is, but the direction of the risk is clear, and you now have a framework, 30 days, 60 days, 90 days, to get yourself positioned on the right side of what is coming. Share that video with someone in your life who needs to hear this, because the best financial safety net you can give someone you care about right now is not money. It is information and a plan. Stay prepared, stay patient, and I'll see you in the next one.